Hello and welcome to Monthly Funds Update. My name is Marek Krzyszkowski and I'm joined by Ryan Falls. Today we will talk about market outlook and what happened within diversified funds last month. Obviously, last month was quite an eventful month with both equities and bonds selling off. However, we still remain positive on the markets and believe that the soft landing is the most likely scenario. So here we are showing you our latest vote within the investment team that we did on the number of macroeconomic scenarios. While soft landing is our favorite, one thing that you will notice compared to last month is that scenario of too hot has actually came up quite a lot by 5%. And that is on the back of a very strong data that we see in the US. And other than that, small drop in the hard landing scenario, as we believe that the scenario of US recession at the moment, looking at the strong growth and employment data, doesn't look likely this year. Now, we've talked about inflation time and time again, but it's again a very important thing for our positive outlook. Now, we need inflation to come back to the Fed target for central banks to be able to cut rates. And we have seen inflation drifting lower over the last few months. Now here on the right-hand side, what we're looking is the composition of PCE inflation. And there are two things you will notice that goods inflation that we saw last year is no longer a feature. We actually have a small disinflation in goods. However, what is a bit stubborn is housing and core services inflation. So housing inflation here on the left-hand side, this is mostly driven by shelter inflation. And in the US, how this is measured, it is a survey where household owners are asked about hypothetical rent that they would charge every month. So it's not really rent that people pay, but it is a survey of what people think their house is worth. Now, this is a lagging indicator, and we're seeing this is actually drifting lower. So we would expect this to come back to the normal range within the next few months. But the question then remains, what happens with core services? As this is another big component. And one of the key drivers of that core services inflation over the last year was a strong wage growth and a very strong employment market in the US. And again, we are seeing a significant improvement both on the number of jobs and wage growth. So here on the left-hand side, there is a number of different measures of wage pressures that are clearly easing. Wage growth is coming down. Also, more timely indicators like posted wages are showing that wage growth is looking like it's going back to where it used to be before 2022. And on the right-hand side, the number of US job openings keeps drifting lower. So we believe that it's very difficult to see inflation rebounding when the labor market is actually softening. In New Zealand, obviously a less rosy scenario. We have a recession again. We see a number of economic indicators in contraction. However, again, the key question for us is the inflation in New Zealand and how quickly would that come to the point where RBNZ can cut rates. We think that should happen this year as we see inflation trading lower, but there is a bit of a lag if you look at New Zealand inflation versus global. Now, things are, especially on the unemployment front, are not looking great. Official expectations from RBNZ are that unemployment will be somewhere at the, as you can see here, they are a lot more optimistic than most of the financial institutions. with some of the banks seeing unemployment peaking at around 5.5%. On the right-hand side, you can see that New Zealand job ads have been dropping quite rapidly. If you think about the pace of deterioration, not just the level where they are at the moment, but how quickly that has come down. The last time we've seen something like that was actually during GFC. Also, the number of applicants per job ads have more than doubled from last year. So overall, we would expect globally that US and our global markets are looking quite strong, but New Zealand has some challenges, and perhaps the picture is a bit more challenged than globally. Right, and I'll pass on to Ryan to talk about funds.
Thanks, Mark. I'll quickly take you through the Diversified Income and Diversified Growth Fund, and we'll start off with the Income Fund. So asset class performance was negative in April, as resilient data under markets with potential for rate cuts in 2024. So as you can imagine, fixed income was the largest detractor as interest rates rebounded, and that contributed negative 0.7%. Australasian equities was next at minus 0.5%, and then finally global equities came in at minus 0.4% during the month of April. Turning to the positive contributors first, within global equities, we had Novo Nordisk up 2.4% in April, and Schneider Electric up 2.6%. Novo Nordisk actually appreciated during April as the company executed on their share buyback program. And then for Schneider Electric, markets reacted very positively to their first quarter results, where they reported a rise in revenue, confirmed their full year guidance for 2024. Within Australasian equities, we had Fisher & Paykel Healthcare was up 11%, and that was the largest positive contributor within the asset class, and that was on the back of a strong trading update during the month. Turning to our negative contributors, staying with domestic, we have Charter Hall Group was down 12.8%. The wider property sector struggled as interest rates moved up rapidly over April, and this put a lot of pressure on underlying asset values for those property companies. Turning to fixed income, as I mentioned, it struggled on the backdrop of higher interest rates. As an example, the New Zealand 5-year overnight index swap rate was up 0.41% over April, which is quite a large move. And the New Zealand yield curve largely followed overseas moves. This was on the back of some sticky inflation prints globally in the US and then also Australia. And then markets ended up reassessing the path to interest rate cuts for central banks. Turning now to the Growth Fund, asset class performance was also negative for the Growth Fund in April. And as I mentioned about that, rate cuts and reassessment by markets. So overall, the fund was down 3.1%, with global equities being the largest negative detractor at minus 2.4%, as markets whipsawed on the back of those yields marching higher. Australasian equities also fell in tandem, so it was down 0.6%, and then fixed income came in negative 0.1%. In terms of positive contributors, we had Schneider Electric here again up 2.6%, and then Boston Scientific Corp was up 6.3%, and they're the top two contributors. Boston Scientific, they released details on strong Q1 results in April, with revenues and earnings up compared to this period last year. And again, domestically, we had Fisher & Paykel Healthcare, which was up on the back of that strong trading update, and up 11% in April. In terms of the negative contributors within global, we had Accenture was down 13.2%, and Adyen was down 27.9%, and the other largest negative contributions. Adyen actually slid after announcing their quarterly update, where revenue growth slowed to 21% after tougher price competition within the North American market for payment processing. And then domestically, within Australasian equities, Serco was down 4.4%, and this suffered from investors and the market fretting over its upcoming contract negotiations with Booking.com. Should note, however, after the close and the end of the month, they announced a new 5-year partnership, and the stock reversed all those losses from April.
Thank you for listening. If you have any questions, please send them to info@mintasset.co.nz.